You're watching NDTV Profit and The Smith Show. I'm Hiral Dadia. Let's discuss a company that has actually given investors returns of over 5 times in the last 1 year itself. Now, the question is whether investors should be looking at the stock or the product that the stock deals in. Yes, we're talking about Sky Gold. Joining us on the show to discuss more is Mangesh Chauhan, MD and CEO at Sky Gold. Mangesh, good morning and welcome to the show.
Good morning out to all of my viewers and shareholders.
Mangesh, my first question coming to you is overall, taking the festive season demand into consideration, how has it been so far? You already have the wedding season that has started, and in turn you have gold prices which are skyrocketing. How is that entire phenomena working out?
Demand is the way of demand is very good because of the festive season ahead. Marriage season is going to come and on ahead, and gold prices are going rising very heavily because of geographical wars are going on, and US bond yields are on high and interest rates are high, so gold prices are going higher. But it will not impact the demand of our jewelry because our jewelry segment is from 5,000 to 50,000, 50,000 to 1 lakh inventory we are making. So it's very reasonable and compatible price inventory we are making. So it's a good demand in India here and globally also. Customers are getting a good returns on gold. They are gaining the faith on the gold because whoever buy gold before 2-3 years, they are getting the double return of the gold now this year. So as per demand, gold jewelry demand is very good here.
Right. One question, Mangesh, I have with you is the kind of uptick that we are seeing in terms of the revenues as well. Is that a gold price-driven revenue uptick, or is it more of a ticket size or the grammage of gold? From a volume perspective, how is it?
It's in volume wise, in grammage wise also we have grown by 20-30%, and of course price has led also growth 10%. Gold price also led to growth of revenue, but in quantum wise, grammage wise we have grown 30%, so it both together, but by volume wise it's grown 10%, so both are helping together. Yeah,
right. Apart from this, if you see from the marquee clients that you have been working with as well, clearly, we see a lot of good names that are on your list. What's the expansion plan from here on? Because you have Malabar, Kalyan, Joya Lucas, GRT, Samco, and we've been hearing of Tanishq, who could have been added as well to your portfolio. So what's the client expansion plan?
Yeah, we have much more corporate clients on our board, or India's largest top 20 corporates. Out of that, 15 corporates are with us and we are doing business with them. We are targeting right now India's largest 2-3 huge largest brand to be on board with us. I will not like to name anybody, but we are on target to onboard them. So already we are doing it with all huge corporates, and more huge corporates more to come on board.
Right. Mangesh, overall, in terms of capacity as well, a monthly gold processing capacity of 750 kgs is what you've already expanded to. How is that expected to work out, and when do you see how much revenue contribution you will see out of it now?
Yeah, we have the facility, huge facility in Maharashtra of 80,000 square feet, where we can go up to 5,000 crore revenue in next 2.5 years. We are targeting, and we can produce up to 750 to 800 kgs per month. In next 2 years, we are targeting to go up to that level and utilize the facility to the maximum.
So in terms of FY24 and say the next 12 to 18 months, what will be the utilization be at this new facility now that you have?
I think in next 12 months we are targeting to go to about 1.5 years 3,000 crore, and next second year we are targeting to go to 5,000 crore. So we will be producing from 250 kg to 750 kg in 1.5 year or 2 years time.
Okay. And Mangesh, clearly, if you see from exports perspective as well, it contributes around 3% to your overall revenues. You've said it can be scaled up further, but how much are you looking to scale up exports to as a percentage of your revenue contribution? And will it be margin accretive to the business?
Yeah, 100%. We are targeting UAE market and Malaysia, Singapore, and we are expecting our 30% revenue to generate from the exports markets because they are growing very good. There is a huge demand of Indian jewelry there, and this will add on to our margins also because exports have good margins in our products. So it will be 30% of we are targeting to generate revenue from export.
Okay, so you've said that this will be margin accretive, 30% coming in from exports. By how much will you be able to improve your margins? Because clearly you are expecting growth to be accompanied by higher operating margins, and that's what you have said time and again. You are looking to, actually increase the share of studded jewelry as well, and that could be aiding margins. So from currently where margins are, what's the target?
100%. We are at now 2.5, 3.3% PAT margins, and we are targeting to take it to 3.54% in futures. So we are on that, and we are making new monopoly products for that, and we have launched some exclusive products for the corporates which are generating the margins. So let's hope we are reducing our finance costs also, labor cost and all, which is replacing by the automation and machineries in our factory. So it will all help us to improve our margin by 1% more.
Okay. And how are you looking at the debt picture as you mentioned about it? Because the debt to equity is pretty high as well. And the reason is mainly high receivables as well as the inventory that you build on. So is that a sustainable number that you are living with right now?
Yeah.
Or do you think there will be, debt repayments that will be at bay from here on, and the plan will be to reduce debt? What's the strategy?
Right now we have entered a new huge facility. We have done a capex for machinery for 15 crores. So there is no sense in repaying the debt now. We have got new funds in preferential round of 100 crores. So we have to just utilize the facility and enjoy the fruits of that. So we will be first taking the facility to the maximum utilization, use the funds and generate the revenue and profit, and then after 1 or 2 years we can repay the debt easily when the profits are double or triple in 2 years and revenues are triple, and we can repay the debt. So we will be using now funds to encash our facility.
Okay. So from here on, what's the cost of debt that you're looking at currently?
Currently we are cost of debt is 9%. We are reducing the cost fund to 3%. We are going to gold metal loan also, option also. So we are into it to reduce the cost of fund also.
Okay. Mangesh, another question I have is the negative cash flow from operations and the kind of jump that we've seen in the working capital cycle as well. What is the strategy to optimize the cash flows and turn positive on that front?
Yeah, we are reducing our inventory, lead time of inventory time from 30 days to 25 days, 20 days. Our receivable times we are looking into bringing down to 30 to 20 days. So our cycle which is going on 60 days, it will now be, we are targeting to bring it to 40-45 days to churn the capital. Now we are churning it 6 times to 8 to 9 times in a year.
Okay. And when I was looking at your top 5 customer contribution as well, in FY19 you had around 45% of contribution coming in from your top 5 customers. It has increased to 72%. Is there any reason for that? Because in one way you're adding more clients, but the contribution of revenue from your top 5 clients is increasing. So what's that math looking like?
Yeah, parallelly our revenue is increasing by drastically by 40%. So both have rolled. New clients are also, we have added new clients. They are also generating the revenue, and from the existing client also revenue is growing. So parallelly it's going both together, and already we are growing by 40% in last 2 quarters. So it's adding from both the side. Our existing customers are also growing, and new customers also we are building up the revenue from them also.
Right. Mangesh, lastly, if you talk about the revenue, EBITDA and PAT, a 9%, 36% and a 65% CAGR is what we've seen in the last 5 years for the company. And the return ratios of the company in terms of the ROE and the ROCE is also pretty healthy in FY23. Is that something that you will be able to maintain going ahead? Or what is the best that you're targeting as a key milestone on both these aspects?
Yeah, return on investment, we are targeting to take it up to 25-30% from 20%, because we are concentrating to reduce our employee cost, fixed cost, facilities ready. We have to just accelerate and take the advantage of this. So more advantage will be there in 1.5 years, 2 years, because our costs are already incurred about the facility and all. So we will go up to 25-30% return on investment here.
Right. And very lastly, in terms of any guidance that you would want to give over the next 2 to 3 years, what's that target milestone you want to achieve in terms of top line and bottom line?
We want to be a huge India's #1 manufacturer, large manufacturer we are targeting to be, and we are targeting a 5,000 crore turnover to produce 8 to 10 ton yearly in near about 2 years.
Right, so that's going to be an interesting story to watch out for as well. Thank you, Mangesh, so much for joining us on the show and speaking to us at NDTV Profit. So that's a company which has clearly given investors over 5 times returns in the last 1 year, and the journey looks upwards and onwards from the guidance that we have been picking up so far from the management. That's all that we have on this session. Thanks for watching, and lots more lined up on the other side. Please stay tuned to NDTV Profit.